So Megasoft sells software products. The book value of its assets is $2 billion, which is financed by $1.2 billion of equity and $0.8 billion of debt. Its before tax cost of debt is 8% and its marginal tax rate is 25%. It has a cost of equity of 10% and the abbreviated income statement is shown below. So EBIT less interest expense gives you pre-tax income, less tax expense gives you a net income of $50 million. Determine whether Megasoft is profitable by calculating residual income and explaining its relationship with reported accounting income. Now, the net income that Megasoft earned was $50 million. The book value of the company, or what shareholders have invested in the company, is $1.2 billion. So on $1.2 billion of investment or of book value, the required return is the cost of equity, which is given to be 8%. So if Megasoft is earning an 8% return, it's not doing anything extraordinary or supernormal. 8% on a book value of 1.2 billion is a required return. So 50 million was our given return, wherein the required return is 1.2 billion or 1200 million into 0.1, that is equal to $120 million. So the residual income earned by Megasoft in this year is 50 minus 120, that is negative $70 million. So even though Megasoft may be profitable, this profit is only after considering the cost of debt, because interest I have deducted. If I apply the cost of equity also, then my shareholders for a $1.2 billion investment could have earned 120 million anywhere. Had they put their money anywhere else with a similar risk, they would have been able to earn 120 million. So Megasoft, by earning $50 million, has actually destroyed $70 million of shareholder wealth, or the residual income is a negative 70 million. Megasoft reports NOPAT of $1,000, a WACC of 10%, and invested capital of $15,000. The market price of the firm's stock is $25 per share, and Megasoft has 600 million shares outstanding. The market value of the firm's long-term debt is $5,000. Calculate Megasoft's economic value added and market value added. Economic value added is the NOPAT minus $WACC. NOPAT, that is EBIT into 1 minus tax, is given to be $1,000. WACC is 10% and invested capital is $15,000, giving an economic value added of minus $500. Market value added, we just saw, is the market value of invested capital minus the invested capital. Market value of invested capital is nothing but the market value of equity plus the market value of debt. So market value of equity is $25 per share multiplied by 600 million shares, plus the market value of debt is $5 billion or 5,000 million. So we need the residual income at the end of 2009, 2010 and 2011. So we will first try to get the beginning book value. And using that, we will calculate the residual income as the net income minus the beginning book value into the required return on equity. The beginning book value as of 2009 is $10, that is given. The net income, or rather the earnings per share, is given to be $2. So the residual income will be calculated as 2 minus the required rate of return, that is 0.1 into 10, which will come out to be equal to $1 for 2009. The dividend payment in 2009 was $1. So of the earnings of $2, $1 was paid out and $1 was retained. So the beginning book value for 2010 would be 10 plus 1, that is $11, on which the net income or the earnings per share were $4 minus an equity charge of 10% of $11, that will be 1.1, which will give us the residual income for 2010 as $2.9. For 2011, the beginning book value would be $11 plus the retained earnings. Of the net income of $4, $2 was paid out as dividends, so another $2 were retained in the book. So the book value at the beginning of 2011 would be $13. The residual income would be the net income, that is $6 minus the equity charge, that is 10% of $13 now, because on $13 the required return is 10%, which will give us the residual income for 2011 as $4.7. For 2012, 13, 14, what is the book value or the beginning book value? 0. Since everything has been paid out as dividends, 2011 dividend was a liquidating dividend. So there is no book value and there is no net income. So the residual income henceforth will be 0. So we began with a book value of $10. To the book value of $10, were we able to add anything? We were able to add $1 in 2009. We were able to add $2.9 in 2010 and $4.7 in 2011. After that, we weren't able to add anything to this book value. So the $1 will be discounted back by 1.1 upon 1.1 to the power 2 and upon 1.1 to the power 3 to give us the value of the stock today, which comes out to be $16.83. Let's come back to our residual income model and let's try to calculate the value of the firm. Megasoft has a book value of $20 per share. The company's ROE is 20% and its required return on equity is 10%. The dividend payout ratio is 60%. Calculate the value of shares using single stage residual income model and the present value of the expected economic profits. So the book value per share is $20 to begin with, and the ROE is 20%. So the next year's residual income would be 0.2 minus 0.1 into the book value of $20. The dividend payout ratio is 60%, And in a single stage model, we assume that this ROE will continue forever. If this ROE continues forever, then the growth will be equal to the retention ratio into the ROE, that is equal to 8% or 0.08. Hence, these earnings will continue to grow at 8% forever, or the present value of this residual income would be upon 0.1 minus 0.08. Which will give us the total value as 20 plus this number, which comes out to be equal to $120. The present value of the expected economic profits is $100. Use the information in the previous example to calculate the value of Megasoft using the Gordon growth model. So same question. We are now asked to calculate the value using the dividend discount model. So in the dividend discount model, we don't care about the book value. In the Gordon growth model, we need D1 and we need to discount it back by R minus G. This was the next year's residual income. ROE into G or into the beginning book value is the next year's earnings, not the last year's earnings. So D1 is equal to ROE into the beginning book value. So beginning book value is 20 into the return on equity is 20% into the payout ratio is 0.6. So D1 will come out to be $2.4. The required return on equity is 0.1 minus the growth rate we already calculated is 8%, which will give us a value equal to $120. So please note, residual income is another method of valuing the company. It will not give us a different answer. Correctly applied, all valuation methods will give us the same answer. Megasoft is expecting an ROE of 20% over each of the next 5 years. Its current book value is $10 and it pays no dividends and all earnings are reinvested. The required return on equity is 10%. Forecasted earnings in year 1 to 5 are equal to ROE times the beginning book value. Calculate the intrinsic value of the company using a residual income model, assuming that after 5 years, continuing residual income falls to 0. So we are given the earnings in each of the years. We are given the ending book value. The equity charge will be the required return on equity multiplied by the beginning book value. So we are given the residual income that we can calculate for each of the years as the expected income or the net income minus the equity charge. So if after year 5, that is year T, that is the high growth phase, ends, there is in year 6 there is no residual income, then the value of the 5th year's income at T equal to 4 will simply be 2.074 divided by 1 plus R. This will be the value in year 4, and then we can discount these 4 cash flows back and compute the value at T equal to 0. Add to this the beginning book value, and that will be the value of our company. The ROE is 20% for the first 5 years and the required return on equity is 10%. There are no dividend payments, so everything goes back into retained earnings. So 20% into 10 would be $2. So it will become $12 into 20%, $14.4 into 20%, so on and so forth. The equity charge would be the beginning book value multiplied by 10%, that is the required return on equity. So this is the case where omega is equal to 0 or there is no persistence in the earnings.